Welcome to All About Investment, a education series focused on demystifying investments for retail investors. In this module, I am very excited to cover bonds. Bonds worldwide happen to be one of the largest asset classes, sometimes bigger than more known equity and real estate. But in India, it's a smaller component. And for retail investor, bonds are a very small part of their portfolio. Fixed deposit and PF are no bonds because their prices don't change. To demystify bonds, it's very important to understand bonds and its characteristics. If you look at in the chart, bonds are nothing but like giving loans. They are very similar to fixed deposit, but with many advantages. It is more liquid than FD. You can sell bonds in market at any point of time. They are very liquid. It's completely safe because we are limiting it to only sovereign or semi-sovereign bonds. In simplest language, bonds are like giving loans to someone. In a way, bonds are very similar to fixed deposits, but with many advantages. It is much more liquid. Okay? You can sell bonds at any point of time in the market, unlike fixed deposits. It's completely safe. We are limiting it to only sovereign and semi-sovereign bonds. And if you look at in India, sovereign and semi-sovereign bonds are a bigger component of the overall bond market. And return, please don't confuse it with the coupon rate. Coupon rate is one dimension, right? They are typically fixed payments, typically around 8%. But there is a capital gains or loss, right? We expect post-tax returns of about 12 to 13% because of the environment, which we will explain in next few slides. But first step to understanding bonds is bonds are alternate to fixed deposits, right? They are much superior in terms of returns, which could be as high as 12 to 13% in next 2 years, unlike 5.5% of fixed deposits. Right? Now, to understand this second dimension of capital gains or loss, we need to understand in the next slide what drives the bond price. Bond prices are essentially determined by interest rate, inversely correlated, right? A typical thumb rule is that 1% reduction in interest rate can give up to 10% increase in prices for longer duration bonds. Interest rate in turn is determined by inflation, right? Typically, an interest rate would be 1.5 to 2% above inflation. To understand inflation, typically in this list, CPI of different countries are given. And as you would see that in most part of world and especially developed world, inflation is below 2%. Economic theory worldwide well recognizes the fact that low and stable inflation is vital for high economic growth. Most countries have inflation which is lower than 3.5%. Most developed economies lower than 2%. However, inflation in India at over 9% till very recently was an aberration. Even now it is very high, right? Central banker has mandate to keep the inflation in check, and Governor Rajar is doing a great job of it, right? It has, if you see what is in the next slide, inflation is coming down in India. Consumer price index has come down from around 10% to about 4% in last 12 months. In fact, there are other measures of inflation and the wholesale price index, which is mostly overweight on commodities and manufactured goods, have been negative for the entire calendar year, -2 to -4%. And a neutral one, something like a GDP deflator, which is weighted average view of the entire GDP, right, is close to zero right now. So the inflation is definitely coming down in India. There is a central banker is very determined, and China slowdown has ensured that there is a significant drop in commodity prices, bringing down the wholesale price index significantly, right? So at least one thing we are sure that benign inflation outlook, right, is prevailing. However, they are not reflected in bond prices. We feel that as an aberration, and based on that, we feel that the bonds are expected to give very good returns as given in the next slide. The return over next 2 years, right, interest rates are very likely to come down by about 2%, right, okay, to say about 6%, right. The long-term interest rates, which are around 7.7, 7.8%, will come down to about 5.8%. This will give a capital gains of about 15% on long duration bonds over next 2 years. Right? So if you see bond returns, expected annualized return, right, will be about 13 to 14%, 7% because of capital appreciation, and 7% because of coupon rate. Right? So that's a very good expectation which we have, and not only us. I think the biggest bond investor, LIC, has similar views, as you will see in this newspaper. Right? And in the next slide, right, if it looks too good to be true, please note that between 1996 till about 2004, bond yields fell by about 1.25% per year, giving a capital appreciation of about 8 to 10% for the entire period of 1996 to 2004. So for it to give it to for next 2 years, right, okay, is very, very likely, right. So to understand that bond return for it has also been very good in India, and it's a very good option, right, in a falling interest rate scenario. Bonds are a very good investment, and it is not that retail didn't know how to invest in bonds. They only knew about debt mutual funds, and debt mutual funds, because of their tax treatment, has become less attractive. But then even if we restrict ourselves to very high quality sovereign and semi-sovereign bonds, right, like gilts issued by central government, right, that's for different duration you have that's the largest component of bond market, right, and it trades in large quantities but on interbank markets, not on stock exchanges. You would have seen the primary issue of some tax-free bonds over last 3 to 5 years, and they give about 7% return. They come from many semi-sovereign organizations. Perpetual bonds by banks has always been in small quantities. Corporate bonds are the only ones which have not developed fully, but are likely to develop in short period of time. So to summarize, we always knew that risks of bonds are very low. But what I would like to highlight, that expected returns over next few years from bonds are also very good. And you have good options. But please don't treat PF and FDs as bonds. In fact, most of the retail investor in India is heavily underweight on bonds. In many cases, they are negative. If, if you have home loans, they are like negative bonds. And in this era where bonds look very attractive, it is very important for retail investor to understand bond market and invest in it. You can go through mutual funds, but because of new tax rules, they have become less attractive. Hope this session was useful to you. Thank you.